In this video we are going to talk about the magic of dividend investing. So before starting this video, please like this video and subscribe to this channel for our future updates. Many first-time investors are unfamiliar with the concept of a dividend and how it pertains to an investment, particularly when it comes to individual stocks or mutual funds. It is customary for publicly traded companies to pay out dividends to their investors who are eligible to receive a portion of the profits made by the company. However, not all corporations distribute dividends. Typically, the board of directors chooses whether or not a dividend is appropriate for their particular firm based on a variety of financial and economic considerations. In most cases, dividends are given to shareholders in the form of cash distributions, which are made on a monthly, quarterly, or yearly basis. The fundamentals of dividends. Before receiving a dividend payout, or distribution, on their stock, shareholders of a certain company must first complete a number of requirements. It is necessary to be a shareholder of record on or after a specific date defined by the company's board of directors in order to be eligible for the dividend payout to be eligible. Occasionally, stocks are referred to as trading ex-dividend, which simply implies that they are trading on that specific day without being eligible for a dividend distribution. Purchase and sale of stock on the ex-dividend date will result in the stock not receiving the most recent dividend distribution. Now that you have a basic understanding of what a dividend is and how it is dispersed, let's go into greater detail about what else you should know before making an investing decision in the stock market. What is the dividend yield? It may seem counterintuitive, but as the price of a company rises, the dividend yield of that stock lowers. Dividend yield is a measure of how much cash flow you are receiving for every dollar you invest in a stock or other investment. Many new investors may make the mistake of assuming that a greater stock price equates to a larger dividend yield, which is simply not true. Let's take a look at how. Dividend yield is calculated to get a better understanding of this inverse relationship. Dividends are typically paid out on a per-share basis in most cases. If you possess 100 shares of the ABC Corporation, the 100 shares serve as the basis for the distribution of dividends to you. Take, for example, the assumption that ABC Corporation was purchased at a price of $100 per share, resulting in a $10,000 total investment. Profits at the ABC Corporation were extraordinarily high, and as a result, the company's board of directors has agreed to give its stockholders $10 per share in cash on an annual basis. In other words, if you are an owner of ABC Corporation for a year, your ongoing investment in ABC Corporation results in dividends of $1,000. The annual yield is calculated by dividing the total dividend amount, $1,000, by the cost of the stock, $10,000, which results in a yield of 10%. In contrast, if ABC Corporation shares were purchased for $200 per share instead, the yield would be reduced to 5%, because 100 shares would cost $20,000 instead of $10,000, or your original $10,000 would only buy 50 instead of 100 shares. As previously showed, if the price of a stock rises, the dividend yield falls, and vice versa if the stock price falls. Dividends are a portion of a company's profits distributed to eligible stockholders on a monthly, quarterly, or yearly basis, depending on the circumstances. Generally speaking, a company's ability to pay dividends is a solid indicator of its financial health. Identifying and evaluating dividend-paying stocks. The essential issue to ask is whether dividend-paying equities are a good overall investment in terms of overall return. Dividends are earned from a company's profits. Thus it is reasonable to infer that dividends are generally regarded as a positive indicator of the company's financial health. From the perspective of investment strategy, purchasing established companies with a track record of paying out high dividends gives stability to a portfolio. If you keep your $10,000 investment in ABC Corporation for 1 year, it will be worth $11,000, assuming the stock price remains same after 1 year. More to the point, even if ABC Corporation stock is trading at $90 per share a year after you purchased it for $100 a share, your entire investment, including dividends, is still break-even, $9,000 in stock value plus $1,000 in dividends. Buying stocks with dividends has the advantage of not only helping to cushion drops in the real stock price, but also providing the chance for stock price rise while also providing a continuous stream of income through dividends, which is appealing. For this reason, many investing legends, such as Warren Buffett and Benjamin Graham, advocate for the purchase of dividend-paying stocks, believing that dividends are a crucial component of the total investment return of an asset. Portfolios with a high dividend yield are considered long-term investments. In the event that you hold stocks or index funds, it's quite conceivable that you're already engaged in some form of dividend investment. For example, around 77% of the equities in the S&P 500 pay a dividend. And while the current dividend yield of the S&P 500 isn't very high, 1.7%, it is significantly greater than the average annual percentage yield (AP) on savings accounts or even the yield on treasury bonds. Nonetheless, it is modest when viewed in historical context. Throughout most of the 20th century, the annual dividend yield of the S&P 500 varied between 3% and 5% every year. Dividend yields have been declining in recent years as firms have become more conservative with their cash payouts. There are a variety of causes for this, including dividend stocks face limited competition because of low savings account rates and bond returns, to name a couple of factors. The prospect of receiving a 1.79% dividend would not be all that appealing if savings accounts paid 3%. However, given the current interest rate environment, there is less motivation to increase payouts. Aside from that, technology corporations have grown in importance over the last several decades. Furthermore, as an industry, technology businesses often prefer to invest in new items that will generate rapid growth rather than simply paying dividends to shareholders. How dividend reinvestment helps you earn more profit. However, dividends continue to be an important component of your overall investment returns, notwithstanding these trends. When you reinvest dividend payments to purchase additional shares of stock in your investments, you are assisting your portfolio in benefiting from increased compounding effects. On a fundamental level, each dividend you reinvest permits you to receive additional dividend payments in the future, which can significantly increase your investment returns over the long term. Consider the following scenario. You made an investment in an 500 index fund in January 2000 and kept it until September 2020. You would have earned an average annualized return of 4.2% based only on stock price gains, for a total return of 136%. That's quite good, isn't it? However, if you had reinvested all of your dividend payments back into the fund over the same time period, your annualized return would have been 6.2%, for a cumulative return of 247%. You might have nearly doubled your profits by just reinvesting earnings. If you fiddle with the numbers a little bit more using this calculator, you'll discover even more spectacular results. Consider the following scenario. You made a $10,000 investment in an S&P 500 index fund in January 1990. Based only on price increases, you'd have approximately $91,300 now. Adding in dividend reinvestments though, you'd have nearly twice that amount, or $180,000, at your disposal. Benefits of dividend investing in terms of taxation. When it comes to income investors, dividend investing can give significant tax benefits. It should be noted, however, that the Internal Revenue Service, IRS, does not regard all dividends the same. Generally speaking, dividends can be divided into two categories: qualifying dividends, which are taxed at the lower long-term capital gains rate, and unqualified or ordinary dividends, which are taxed at the standard income tax rate. Qualified dividends account for the vast majority of dividends paid by U.S. firms. The income from dividends is taxed at the long-term capital gains rate if investors hold the stock for more than 60 days, which is the case in the vast majority of cases. Certain additional dividends, such as those received through real estate investment trusts, REITs, or master limited partnerships, MLPS, are often classed as ordinary dividends and taxed as ordinary income under the federal tax code. Ordinary dividends are paid out by money market funds and other cash-like assets as well. Generally, dividends received in tax-favored retirement plans, such as individual retirement accounts, IRAs, or 401(k)s, are not subject to taxation until they are distributed to the account holder. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.